Hello everyone, today we are here with another lecture of CIE Part 2, Unit 4, which is about Annual Internal Audit Plan. Those who are joining for the first time, this is a brief introduction about myself. So if you are interested in reading, you can pause the video and you can read it. Otherwise, you can just skip it and go to the next slide. So far we have covered in our lectures from Unit 1 till Unit 3, and in our today's topic is about Unit 4, the Internal Audit Plan. By the end of this session, we will be completing around 20% of our entire syllabus for CIE Part 2. This is very interesting topic. The good news for you for today's session is it's very brief and concise, and there is limited information that you need to retain in your memory. The most important thing is to understand the concept, to understand the sequence, and once you understand the concepts and the sequence, how you can go or embark on the journey of having an annual internal audit plan, then it will be easier for you to answer any difficult question. Just to have a quick look, in the first unit we talk about some basics about internal audit operations. We talk about the types of assurance and consulting engagements. Then in the second one we talk about certain types of assurance and very specific about the compliance related engagements, how an internal auditor can play their part in these kind of audit engagements. The third was more elaborative in terms of how you can carry out a financial audit and mirror the work of how the statutory or external auditors carry out their work, because mainly in the financial audit our main focus is toward the true and fair representation of the financial statements, where we talk about the recording and the presentation of information in a fair manner, and also about the accuracy. We talk in detail about environmental consulting. Environmental auditing. I personally like this section because there is a talk of the town about environmental, social, and governance. So ESG concept these days. So this specific section plays a very vital role in understanding about the environmental risk and how we as an auditor can play our role. And lastly, we talk about consulting engagement, the role of internal auditor in consulting engagement. Also, we talk about what are the other types of consulting engagement that we can perform without even compromising on our independence and objectivity. Today's unit will be very interesting, so let's begin with. This is a mind map for you to know what we will be covering in our today's unit. And basically there are three sections. We will be going a bit in detail. We will be talking about risk-based audit plan. We will be talking about risk modeling. This is an approach that how we assess the risk, and the last one is about the communication reporting protocols for the chief audit executive and internal audit in general. So these are the three sections which we will be covering in our today's video. The first question arises whenever we talk about risk-based audit plan is, what is risk? So risk is any adverse incident that can lead to that can hinder us from achieving our organizational objectives and have an adverse impact. So this is a simple definition which you can remember. We measure the risk in terms of likelihood and impact. Likelihood is basically the frequency, that how often we can be exposed to that kind of a risk, and impact is the consequences. What will be the financial consequences, reputational, compliance, or any other form of consequences if that risk materialize within the company. Priorities based on risk assessment. First of all, whenever we talk about risk assessment, we have to know what the standard says. So the standards tell us that the chief audit executive has to carry out a risk assessment at least annually, and that risk assessment needs to be documented. So what it says that we as an internal auditor, we do not have any choice of ignoring this step, because we have to be very logical and systematic in approach, and similarly we have to go for a documented approach. And the bare minimum requirement is that we whenever we are doing a risk assessment, we should look into inherent risk, and we look into controlled risk, and eventually it leads to residual risk. The outcome is residual risk, that how much is the risk left over. We will be discussing this in detail in the coming slides. So if an organization is very complex, especially in a very complex organization, risk assessment is a very challenging task. So the auditor needs to understand the organizational objectives, strategies, plans, and see that how each unit within the company, be it you can define the unit by activities, you can define the unit by services that organization offer, or by the product they produce, or the departments that have within the organization. So you have to look at that, how each unit within the organization is contributing towards the achievement of that objective, that overall objectives, and what are the key risks that could lead to an adverse circumstances. So that is very important for the internal auditor to assess. If the organization have an ERM or risk management department, then it's easier for our internal auditor, because they can pick those risk registers. What is risk register? That is another discussion. Let's quickly go through. Risk register is basically where each department keep a register with them, in which they highlight all the key risks, and they look into what are the controls and how they are managing those risks through different controls. So this is a snapshot of the entire risk within the department. And the ERM team, they look into these risk register, they assess those risks, what is the severity of those risks. They see from the completeness perspective as well, because they are the risk expert within the organization. They are not the risk owner. Each individual within the company is a risk owner for their respective areas. So they should be mindful about if there is any risk, and they should own all the risk. However, the risk people, the risk department, they are well trained in terms of risk assessment and risk reporting. So these department, they have these risk register, which eventually being reviewed by the ERM department or compiled sometime by the ERM department, and they look for what are the key risks that could potentially impact the overall objective of the organization. There might be a possibility where there are smaller risks accumulatively affecting the overall objective of the organization, or there might be a single standalone big risk within the department. So eventually they derive from these risks strategic or entity level risk, and which they report periodically as a top 3 or top 5 or top 10 or top 20 risk to the board, and they give their fair independent assessment of how the management is managing those risks. So this is if you have that kind of sophistication within the company, it's much more easier for internal auditor, because we can begin our risk assessment from something. If you don't have, then you can simply take the entire organization, break down to different units, be it through services, operations, units or departments, and discuss with the management what are the key risks within their operations, and you try to encourage them to come up with all the risks, compile those risks, see the controls against those risks, rank those risks based on the severity and overall impact on the organizational objectives. And overall, this is how you can present it. What are the key risks within each department, and as an internal auditor, how you are taking the key risk areas within your annual audit plan. So this is a bit more lengthy discussion, but it is important for you to be very much clear in your thoughts, the role of internal auditor and the role of ERM in terms of risk management. So eventually, after having all those discussion and compiling those risks, the ultimate objective is to prioritize risk. There are techniques we will discuss in the second section of this presentation, which is about risk modeling, that you can deploy in order to prioritize different kind of risk into high, medium, and low, and eventually into what are the key top 5, 10, 20 risk organization, and look and plan your annual audit plan accordingly, where you try to take major area of your audit projects from the high risk areas to assess and to give your independent opinion to the board that how the management, or if the management are proclaimed they are managing well, so you can give an independent assurance. Internal audit engagement should be capable of accomplishment. Okay, overall, the internal auditor needs to be and needs to have the competence to achieve their annual audit plan with the given timelines, resources available. It is very important that we achieve our audit objectives. So this is something, some brief intro about risk assessment and risk prioritization from the audit perspective. Risk-based on audit plan. Whenever we as an internal auditor, we talk about annual audit plan, we talk about risk-based annual audit plan. This is the core of internal audit, where we believe that we have limited resources, limited time. We want to outperform and use optimally our entire resources. The best way to do that is to focus on the most important thing. So similar to the time management thing, where you try to prioritize things based on urgency and importance and impact. Similar to that, internal auditor also, whenever they plan for their annual audit projects, they prioritize based on the high impact engagements. Having said that, it doesn't mean that we deny the fact that there might be certain medium and low risk, which we also take into account in our annual audit plan with a lesser proportion, maybe 20% or 30% of the entire audit plan. The reason why we take on board those areas based on our risk assessment is because there might be a judgmental error, because the entire risk management has or heavily influenced by the judgment of the internal auditor and based on their skill, competence, and experience. So there might be a possibility that the auditor, they consider an area high risk, but it might turn out to be a medium or low risk. Or the auditor might, based on their assessment, might consider or assign low risk to an area which turn out to be a medium or high risk. So just to overcome that judgmental error and to give some kind of a coverage to other areas which are never audited from the medium and low risk, so we can incorporate that area as well. To do that, first we need, as an auditor, we need to have an audit universe. If you are an auditor, your first steps of risk assessment would be audit universe, then moving down to risk universe. However, if you are a risk manager, then it will be different. You wouldn't be considering about audit universe. However, you will start directly from risk universe. So this distinction is important to understand from the audit and risk manager perspective. So since we are an auditor, so we will be starting our risk assessment from audit universe. Audit universe is a term or a terminology which means breaking down the entire organization in smaller auditable units, where we can have 100% coverage of entire organizational areas. It could be through departments. It could, if it is a complex big group, it could be through different companies, different regions. If it within a company there are multiple products, so it could be through multiple products. So if the company is providing an IT and they provide services in terms of different services, so there is no hard and fast rule that how you can divide the organization, but the most commonly used is dividing the entire organization into different departments. So we have to come up with an ideal situation where internal auditor have, let's say, unlimited resources and unlimited time, and they have to give 100% assurance. So what they will do, they will break down the entire organization into different departments. The organization have an audit from all the activities of in each department. So that is called a risk universe, where you can have a high level dissection of the entire organization is in a smaller unit. So what you will do, you will break down the entire organization into auditable units, and then you will look at within each department how many areas. Maybe there are 5 major areas which needs to be covered in order to give fully assurance that their department is doing well. So what you will do, you will divide the entire department into 4 or 5 or 3, whatever the number is, into smaller units, and that become your audit universe. Then you carry out a risk assessment. You look for all kind of risk, and in order to carry out a risk assessment, you can have a risk universe. Risk universe is also goes with the same, that you can have a the entire what you call the scope area of the risk. You can never give an assurance on the completeness, but you do it to the best of your ability, that you cover all the internal, external risk, financial and compliance related risk, operational risk. So you just compile that within each department. And then the third steps comes. So now you have an audit universe. Within that audit universe, you have departments. Within each department, you have auditable areas. Within each auditable areas, you have risks. So those risks become, eventually, if you compile all the risk within the company, it become risk universe. So within those risks, within each department, you just look at which risks are potentially could have a bigger impact on the organization. So you take into account that risk in your annual audit plan. The organization these days are very fluid. They change dynamically. Their structure change, the technology they are using change, their processes change, laws and regulation push the organization to change. Any sudden demand or any sudden changes in the competition or in the environment also lead the organization to adapt quickly to the change. In that case, our audit universe cannot be a static document. It needs to change and evolve. And as a chief audit, as a head of the internal audit department or chief audit executive, it is your job and responsibility to review and evaluate whether there is a significant change within the company that ensure that we have to change the audit universe of the company. While developing an audit universe, it is important that at a high level you have a discussion with the management and if possible with the board, where you discuss with them and you give them the snapshot of the entire organization, just in case if you want to give an 100% assurance that how many audit projects you have to carry out in order to ensure that the entire company is protected or they are managing the risk properly. All the audit work schedules, which is audit programs or audit execution related documents, it all needs to be based on the risk assessment that we perform. So we perform risk assessment at 2 stages. The first stage is at the planning stage, where we come up with the list of auditable projects within a year, and the second step is when we take each project, each unit or each engagement of audit, and we carry out a risk assessment on all the scope area within that domain, and we look at how the proposed controls should be, and what the existing controls are, and how we will apply the audit procedure, and what is the result of the audit procedures. And if there is non-compliance, or if there is not adequate controls, or the controls were not effective throughout the year, that all areas become, or if there is a suggestion to improve further or increase the efficiency and effectiveness of the control, that all become part of our audit recommendation to the client. So this is some brief discussion about the risk-based annual audit plan. Yeah, one more important point: if you are interested in applying these concepts practically in your organization, I have made a video on risk-based annual audit plan where I shared even the sample templates that you can use. It's very simple. I try to keep it very simple, where I ensure the minimum requirements are met. So I will put in the description the link to that video, so you can go and see. It will be complementary to this discussion, but then that video will give you a very good process flow of how we carry out our annual audit plan. So that is important if you want to go in details. Otherwise, from the exam perspective, this is all what you need. Some more generic discussion about the risk management process. Basically, why we carry out a risk management, because the risk management in itself is an element of a good corporate governance, where we are giving a testimony to the shareholders, those who are the owner of the company, that the executive management are doing their job in the best possible manner. They are protecting your wealth, they are protecting the or they are safeguarding the other stakeholder interests in terms of government, in terms of compliance, protecting their employees' right, the society in general, environment. So that is why we need to have a proper risk management within the company. There are companies which do not have risk management. That doesn't mean that these organizations are inherently taking a lot of risk, but rather these organizations are impliedly they are using these techniques without even knowing that they are managing the risk of the company. How come? Every company has a policy and procedure. That is one of the effective form of managing the risk. Every organization have a structure. Within the structure, they have a defined roles and responsibility. They grant the authority. We call it delegation of authority through DOA. There are review, approver, initiator process within each activity. There are benchmarks, standards, thresholds, key performance indicators that need to be met. Their performance is being evaluated. The employees' performance, obviously. Employees are compensated fairly, and they are being told what they are supposed to do, and they are given incentive if they do their job correctly through bonuses. So this is all form of risk management. However, we do not realize this is happening, but just by having a proper risk management department, what happened that they look into if there is any loophole, or further if they want, there is a possibility to further enhance that process, and there is a centralized team which coordinate all the activities. So that is the main purpose of the risk management. Sorry. In terms of risk management, those companies which are very sophisticated, they use a risk framework. There are multiple frameworks within the company. You can use 2 or 3 framework at the same time, or you can use a single framework, or you can have your own version of a risk framework. But the most famous one are the COSO ERM framework and ISO 31000. These frameworks are not a technical documents or technical concepts they just merely give you the idea that what are the key elements that need to be considered while making a risk management, while considering a risk within the company, in terms of understanding the context of the situation, identifying the risk, um, evaluating and assessing the risk, giving a recommendation then how we can manage those risks, reporting about those risks to the key relevant stakeholder, monitoring time to time these risks, and if there is a change required in terms of putting a customized controls or an effective control within the company. So that what we have to consider while doing all this. We have to understand what is the objective of the company, the plans of the company, the external environment. So these frameworks, they just give you an idea holistically that what are the things that you should not be ignoring in your risk management process. Risk management is it can be as complicated as you want, especially in the financial institutions, banks and other, where they are being mandated by the regulators to have a proper ERM team and carry out a proper financial and other operational or compliance to risk assessment. They have sophisticated tools where they look for sensitivity analysis. They do different what if scenarios in order to see that what if the interest rates get high, how much they will be losing or how much they will be gaining, what if the potential fraud risk can increase by this percentage, how much there would be an issue. So they use different kind of tools, but these tools are just to facilitate, so you don't have to be very much worried about if there is any Monte Carlo or any other assessment tools. But the mere concepts remain in a simple word, is you have to understand the concept of inherent risk, control risk, residual risk. These three elements you need to understand, and eventually they are doing the same thing. Inherent risk is basically inherently how riskier that operation is, or anything can go wrong in that operation or activity. It can be further divided in terms of likelihood, what could be the frequency of an issue that might arise in that activity, and impact, what could be the exposure of that activity. So inherent risk is a component of two elements, likelihood and impact of or the severity of that risk. And then control risk. Control risk is inherent risk where we did not deploy the controls, and we just look holistically that if there is no control, how risky that area of business would be. And control risk is when we deployed the control, and let's say we put a password in order to restrict the access right. So then would there be still people who will be managed to break those password? So if there will be a smaller percentage of very high-end hacker, then the residual risk would be low. But if easily a fifth grade student or an normal employee can break that password, or just let's say if it is commonly shared password, so then the control is not effective, which means that the control risk is high, and eventually our residual risk is very high, which means that the ultimate objective of putting or deploying that control to manage that risk does not play its part and does not achieve its targets, and eventually the company is still exposed to the risk. So in that case, the residual risk will be high. So you have to understand, whenever you are carrying out an risk assessment, you have an activity, you look at inherently how risky that activity is, what are the controls currently within the company or potentially there should be in the company, and after that control, will the remedial risk after that control will be high, medium or low, and based on that you carry out an assessment. So this is the simplest way, and if the residual risk is within the acceptable tolerable limits within the organization, then we say that it is fine, it's medium or low. But if it is above and over and beyond risk appetite, then we say it's a catastrophic and we have to take an emergency action, it's a high risk. So risk appetite, again, in some companies it's very well defined in terms of quantity, in terms of consequences, in terms of measurable numbers, but in many organizations it wouldn't be there. But you have to gauge from your experience that what could be acceptable, what could not be. Let's say if a risk expose a company revenue or or it can impact the company revenue by 2%, it will be huge risk, right? But if it is impacting the revenue by 0.00001%, then it might be considered as a low risk. So risk appetite is the benchmark criteria against which we look the residual risk, and we assess whether that activity risk is high, medium, and low. Or sometimes we also, based on the risk appetite, we consider that how much controls, how effective or how much expensive controls we can deploy in that area to manage the risk. What if we put in a password, a door, an iron door, and a metal detector or detection, and a laser beam just to protect that access? Would that suffice the benefit which we are reaching? If it is not, then again we have to measure the risk appetite is a very good criterion based on which we also determine that how effective our control should be, or maybe we do not need to put in control and we just have to accept the risk. So risk appetite is that concept. Internal auditor, whenever we are carrying out our risk assessment, we have to coordinate with other departments and we have to discuss with the management. If you have ERN team, if you have anti-fraud related team, you have compliance team, you have health and safety team, you have business continuity and disaster recovery team, you have operational risk team, then you have to coordinate with all these departments in order to understand what are the key risks within the organization, what are the fraud incidents that happen, how the controls are impacting. If they have any document, you take it as an input and try to come up with your own risk assessment. So just by using other people's expertise and having a very wider knowledge of the organization. Lower risk audits, as I mentioned before, that we have to take into account, which gives an audit coverage to the audit universe, and also it helps us to manage our judgmental error. You have to understand one very important thing which I'm now about to tell. We do not carry out any audit engagements if we do not have the right skills or competence or knowledge of that area. We generally outsource that to other outsource to outsiders, third party. But if we but that doesn't apply in the risk assessment. The risk assessment has to be performed by the internal auditor because it's more of a common sense and judgmental base. So that needs to be taken into account. So this is all for the risk management. Risk modeling, the second section. This is the second section for our today's unit. Risk modeling is basically nothing but we have discussed earlier that we carry out an assessment systematically within the organization and to come up to the projected results of residual risk and what are or provide the ranking to the risk. How we do it? Simply we take the activity, then we look at from the inherent risk perspective, what could be the likelihood and impact of that risks within that activity. We look at if we have a control within the organization to manage that risk, and if it is that there, then we look at what is the residual risk. So this is in itself all is modeling. Whenever we are carrying out risk assessment, some people simply use high, medium, and low terminology to high risk, medium risk, or low risk. Sometimes people use numeric numbers. They assign from 1 to 5 severity, 1 to 3, 1 being the lowest, 5 being the highest, or 3 being the highest. And then they reach out to the final conclusion that if the risk is above 3 or above 4, it will be considered high, and if it is 3, it's medium, and if it is 1, then it's low. So you can use either numerical number if you are happy with and you are good at numbers, or if it's make you feel more comfortable. But I personally use high, medium, and low because I know there is a lot of judgment which is involved in the risk assessment. So coming up with any specific number would be still okay, but sometimes it just distract the management. They start arguing and why 4, why not 3, why 3, why. So rather than that, we focus our discussion on more high, medium, and low in a generic term. Risk factors likely to impact shall be based on audit or professional judgment. Yes, this is what I have told many times. In a consulting assignment, we also look from the risk perspective in order to ensure that we achieve the consulting, whatever the engagement we are taking of consultancy, we achieve the objectives. We are there to able to add value. We have the required skill sets and resources in order to give a fair amount of recommendation or fair judgment to them. So the risk concept does not limited to the assurance engagement, but it can also be applied in consulting. But in consulting, we more focus on ourselves, that how we can add value through our engagement to the client. Within the section of risk modeling, there is an important element of audit risk. Audit risk is not defined by the IIA what is an audit risk, but generally the the American Institute of Certified Public Accountant, AICPA, has defined from their perspective what is an audit risk. Since the CPA, they focus more on the attesting or giving an opinion on the financial statements of the company, so they define the audit risk from that perspective. However, IIA does not restrict us not to use that definition in terms of context and apply that a modified version for our own understanding in internal audit. So from the financial audit perspective, an audit risk is basically the risk of material misstatement in the financial statement into detection risk, where the auditor failed to detect the risk of any material misstatement. Risk of material misstatement, again broken down into two key elements, which is inherent risk and control risk. And detection risk is simply that the auditor, if they fail to detect a material misstatement within the financial statement. How we can use it is, we can use it from the second definition, where it is where we stated that the audit risk is equal to the inherent risk into control risk into detection risk. So we can look at from that perspective that if we properly identify inherent risk, if we properly carry out or understand the control risk, then there is the detection risk will be low, that we can go wrong with our judgment or opinion. But if we did not come up correctly with the inherent risk assessment and control risk assessment, then our detection risk goes high, because in that case we might be wrong in giving any opinion whether the said area which we have audited is properly compliant with the internal policies and procedures and control effectiveness. Technically, the inherent or risk of material misstatement or inherent control risk work adversely or disproportionate to the detection risk. So if the inherent risk and control risk is high, then our detection risk is low, which means that we have to carry out more audit procedure in order to ensure that we do not make a mistake in coming up with the with any misstatement. However, it will work in the opposite direction. If the inherent and control risk is low, then we have to perform obviously less of audit procedure in order to ensure that we do not go wrong with our decision. I hope that I didn't make a mistake, but generally this is a concept. Just double check yourself in terms of detection risk. I just don't want to confuse you, but this is my understanding of the detection risk. This this whole idea of audit risk is basically more in towards financial statements, audit of financial statements, and less to do with the internal audit. But we can apply this concept in our internal audit by being mindful about that, when to increase the audit procedure and when to decrease the audit procedure in order to be more content with our opinion to the client. Now we are starting with our third and last section, which is very concise in terms of communication and reporting. There are certain elements within the IPPA for the standards of internal audit, which states certain things to the chief audit executive in terms of reporting to the senior management and to the board. Whenever I use the word board, it comprises of both board or the audit committee, so do not confuse in that matter. So generally the chief audit executive, they tell about their annual audit plan, the resources they have. If there is any limitation to the resources which they have, they also communicate to the board and the senior management with the impact of not providing enough resources eventually in order for them to take the right decision. Also, if there is a need for interim changes in the plan throughout the year, they also communicate, and again they will talk about the impact of those changes as well for them to review and approve. In terms of approval, communication and approval, the internal auditor, whenever they provide their annual audit plan, the annual audit plan comprises of both the assurance engagement and the consulting engagement. So we club together in front when we are presenting in front of the board, because we have limited resources, we have limited time, and we tell them that how we are using our resources to give the reasonable assurance to the board on the risk management, control, and governance aspects within the organization, and also how we are aiding or adding value to the management through our consulting engagement. We also give them the reason behind why we selected certain kind of a projects throughout the year. Basically, it is based on the audit universe, that how much coverage we are making in terms of the entire audit universe. It is based on the risk assessment, what are the key areas that we are taking into account, based on the discussion of the management or the board, if they emphasize on certain areas to be focused on, if there is any regulatory requirement, mandatory regulatory requirements, so that we have to also take into account. So there are multiple reasons why we are doing that specific audit projects sorry, within the year. We also give them a brief about the objective and the scope of our audit engagement, and overall we have to ensure that our annual audit plan is flexible, because there could be any unplanned or unknown risk that emerge throughout the year. Further, some clarification or some further illustration from the standard in 2060, it talks about that the internal audit has to make a periodic reporting to the senior management and to the board in terms of their purpose, have they achieved their audit objectives or not, in terms of authority they have been granted, in terms of responsibility through their performance assessment, that whether they have delivered the required services to the organization or not, they have completed their annual audit plan or not. So it is through KPIs, key performance indicator, and while doing all this, they were being mindful about the IPPF standards and code of ethics. So without violating any of the standards requirements, have they performed their duties in the right manner or not? So they also have to provide that kind of assurance to the senior management and to the board periodically. Overall, if we can compile all these key points, it will be that the chief audit executive has to provide for the charter to the board for approval, annual audit plan for the board for the approval. After the discussion, obviously, with the management, they have to give an assurance as per the standards annually that to confirm the organizational independence. What is an organizational independence? It is basically that the internal auditor are reporting functionally to the audit committee and administratively to the chief executive officer, CEO of the company, and they are being provided with enough resources. They were being objective in their audit activities. They were not being under the influence of any threat or negative consequences based on the issues they come up. So this is overall called the organizational independence. Impairment, just in case if they were exposed to any threat or any impairment to the independence, which means they were being influenced in a negative way by the management to amend their findings, or to not or they restrict them from getting access to the information, property, or personnel, then that impairment to either independence or objectivity needs to be communicated to the board with the impact as well, in order for them to take the action. Senior management and the board should determine the responses to significant issues which the internal auditor comes up. So they have to determine whether the recommendation which is being proposed or what the management is being or saying that they will do in order to manage the risk is enough or not. So they are the authority in charge, which has to understand and which has to make a decision on those issues as well. The chief audit executive may share and discuss the report with the senior management before reporting to the board. It is very much important, this thing. I've seen some auditors, not all, they give surprises to the management. So when they are presenting the information to the audit committee, at times it happened that they act as a whistleblower rather than being an auditor, where they come up with the complaints or negative statements about the management, rather than looking at the issues objectively and looking at what was the objective of the audit engagement and the issue, and talking to the management, looking from the controls perspective and also looking from their perspective what they have to say about those risks and how they have managed those risks, and then coming up with an independent opinion and giving their recommendation and listening to them. And if they are still in disagreement, then they are supposed to take it to the audit committee. But we cannot act like a fraud investigator. Generally, we act as an auditor, where we give a reasonable assurance on the processes, effectiveness in terms of internal control and risk management. So that's are some of the key elements that the internal auditor are responsible to report to the senior management and the board. And by this, we are here with the end of our today's presentation. As I've mentioned earlier, I will provide the link to the risk-based annual audit plan, practically, that how you can make one in your practical life, just in case if you're interested to know that how annual audit plan look like, how to carry out the risk assessment in terms of template and exercises. Then you can watch that video for more clarification. Otherwise, if you are not so much interested or you're short with the time, this presentation ideally should be enough for you to have the basic understanding of annual audit plan. And lastly, if you felt that these presentations are helping you, please do not hesitate to share with other people so they may also benefit from it. By liking and subscribing to the channel, it will help me and motivate me to reach to more people and be more of good to other people. So it is just a request that if you find it more beneficial, then do not hesitate to subscribe to the channel and share it open-heartedly with other people And pray for me that I keep on posting till I complete the part 2 and part 3 of CIA. I took this responsibility on myself just with the intention of sharing whatever the knowledge I have. And the reason is why, because I felt the resources which were available, even officially, in terms of video lectures, were of a very bad quality, and they make the students more confused. So just to overcome that gap, I try to video record based on my extensive experience and knowledge, and to share from the practical perspective this all units to you. So hope to see you in the next video, and thank you for watching, and looking forward to see you in the another video.